Well, it's 10 o'clock, so we'll get started. And good morning to everybody who's joined our webinar today. Welcome. I'm joined today by Anelia Tabakova from Grunberg & Co, along with Nimesh Patel, both part of our tax team. So welcome to you. And today we're talking about the Enterprise Management Incentive Scheme. So I'll shortly hand over to Nimesh. We're going to have a live Q&A at the end of the presentation today. So as we go through, if you have any questions that you'd like to put forward to the team, please use the Zoom Q&A panel and we'll try and get to as many of those questions as we can at the end of the session. So at this point, I'll hand over to Nimesh and I will see you at the end for the Q&A.
Thank you, Joe, and thank you everyone for attending this webinar on enterprise management incentives. So I think first of all, what I'd like to do is to actually give you an actual overview of what an EMI share scheme is, and also why we're seeing clients wanting to use these share schemes, what the benefits are, just to give you a basic understanding of the schemes themselves, because I'm sure many of you, for the first time, you're coming across this sort of share scheme and not seen it done in practice before. So first of all, what is an EMI share scheme? So it's a HMRC approved share scheme, which means that it's not a scheme which HMRC is looking to target or try to reduce the use of. They actually encourage the use of such a share scheme, which means that you can go into this knowing that there is, specific legislation which supports this share scheme, and you're not having to worry about HMRC's view of the use of this scheme. And as many of you know, there have been various schemes in the past, such as employment benefit trusts and loan schemes, which HMRC have clamped down on, but this is a much more vanilla piece of tax planning, which is very much for those that are not looking to take high amount of risk, but also obtain generous tax benefits at the same time. So the share scheme is available to trading companies, which means it's not going to be available to companies that carry on investment activity. So if you have a limited company that lets out properties or holds investments, those companies are not going to qualify. We're looking at companies that carry on trading activities. And the concept here is to reward key employees. So you don't have to grant share options to every employee in the company. You can select which employees can be granted share options, which gives you a lot of flexibility in terms of how you want to plan to share the equity in the company between the shareholders and the employees. And the key driver for employers is that an EMI share scheme can incentivize employees because they know they can potentially get a stake in the business. And it could also mean that you're retaining key employees because you're going to offer them something that could be valuable in the future. And also, when you're trying to recruit key individuals, we see more and more examples nowadays where it's not just a good salary package a key individual would like, but they'd also want to know what they're going to get in terms of an equity stake in the business as well. And this year, that particular point has become more important because obviously with the COVID outbreak, a lot of businesses are suffering on their cash flow. So they're looking to try and attract employees, and to do so without having a big initial outlay of cash. So if you've got a business which is obviously struggling to pay full market rate salary to high-end potential employees, then share schemes can be a way of enticing those individuals because you don't have to pay them high salaries to begin with, and you can offer them a stake in the business instead. Also, if the company can't afford to pay large bonuses, then this is a good alternative. And also, if you can't afford to pay employees pay rises, which they expect to get, then this is also a good alternative as well. And that's actually these are parts of the reasons why EMI share schemes have actually become very popular this year, because companies don't have the cash flow and they're still looking to retain key employees. So an EMI share scheme could be the difference between keeping the key people in the business and not doing so. So how do share options work? So I mentioned that an EMI share scheme is where you're going to give employees a stake in the business. So what does that mean? So first of all, the company will grant options to the selected employees, which means they're not having to give away shares immediately, but the employees have an option to acquire shares. And they will have an option to acquire shares at a predetermined price. And quite often, various conditions will need to be met in order for the employee to have the right to exercise their options. So, for example, the employer may not want the employee to exercise options until, say, the company reaches a certain level of profitability. Maybe the turnover has to reach a certain amount, or it may be they don't want their employees to exercise their options unless the company is going to be sold or is going to be listed on a recognized stock exchange. So there is a lot of flexibility and it's not an immediate giving of shares. So once various conditions have been met, the employee will then exercise their share options if they're able to buy the shares at the predetermined price. And then once they own the shares in the company, they will hold those shares until they are sold. So I've just got the steps there for you. So qualifying conditions. So because this is a HMRC approved scheme, there are going to be various conditions that both the company and the employee will need to meet. And I've just given you an overview of the main conditions. So first of all, it will basically has to be a small trading company that carries on a qualifying trade. However, there are some excluded activities. So where a company carries on an excluded trade, and that amounts to more than 20% of their activity, then they will not qualify for EMI. And so the main examples are financial services, legal services, farming and agricultural activities, and property development. So where you have a business that carries on these activities and they make up the company's entire business, then that business will not qualify for EMI. However, there may be a situation where the company carries on a qualifying trade, but also carries on a additional activity. So it could be you had a qualifying trading business, but they've used some of the profits to carry on, say, property development activity. So in that scenario, you'd have to see whether the property development activity amounts to more than 20% of the company's activity. And to do that, you'd look at the company's turnover, you'd also look at the company's assets on its balance sheet, and you would also look at the company's management time as well. So you look at these factors as a whole, and then you would determine whether the company has carried on the excluded activities for a substantial amount, which means more than 20%. And if they haven't, then the company should still qualify for EMI. In terms of the size of the company, the gross assets need to be less than 30 million, and they need to have no more than the equivalent of more than 250 full-time employees. So you'd think most small businesses would qualify based on that criteria. And also where you've got a company that's part of a group, then you'd need to look at the group itself when determining whether the 30 million gross asset threshold and the 250 full-time employee threshold has been breached. So, for example, you might have a group of companies where you have a holding company and you also have one or more subsidiaries. So in that scenario, you'd have to look at all the companies as a whole, as a group, and then determine whether the thresholds have been breached or not. The company or the group can grant options over a maximum of £3 million worth of options. And the company that is granting the option must not be controlled by another company. So where the business is made up of one company, that's not going to be an issue. But where you have a group of companies and you've got a subsidiary which the employee works for, the share options can't be over shares in the subsidiary because that company is controlled by the holding company. So what would happen is the share options are granted over shares in the holding company. So the qualifying conditions for employees: the director or the employee cannot have a material interest in the company, which means they can't have more than 30% of the shares in the company. The maximum value of share options they can be granted is £250,000. And that £250,000 limit applies to all HMRC approved share option schemes they're a part of. And also the employees must also work for the company for at least 25 hours a week, or at least 75% of their working time is for that company. So the tax advantages. So the main tax advantages are as follows. So when the options are granted to the employees, then there's no income tax when the options are granted. And also when the options are exercised, if the exercise price set when the options are granted is at least equal to the value of the shares at the time of grant, then there's no income tax when the options are exercised. However, if the options are granted with an exercise price below the value of the shares at the time of grant, then the income tax charge will apply to the difference between the exercise price and the value of the shares at the time of grant. So I'll just give you a quick example. If the exercise price is £10 a share and the value of the shares at the time of grant is also £10 a share, then there'll be no income tax when the options are exercised, even if the value of the shares increases between the date the options are granted and the date the shares are exercised. Now, if the share options are granted with an exercise price below market value, so for example, the value at the time of grant is £10 a share and the exercise price is £8 a share, then when the options are exercised, the difference between £10 a share and £8 a share, which is £2 a share, will be subject to income tax at the time the employee exercises their share options. And if the shares are readily convertible assets, which means if there's a market for the shares, so for example, if the shares are going to be listed, or if the shares are going to be, if the company is going to be bought by another company, then there is a market for the shares, which means national insurance also applies when the share options are exercised. When the shares are sold, they should be subject to capital gains tax. And with EMI shares, there's more chance of the individual qualifying for entrepreneur's relief. So capital gains tax on shares acquired under EMI. So they're liable to capital gains tax when sold, and they are going to qualify for entrepreneur's relief on up to £1 million of gain, which means they pay capital gains tax at 10% rather than the standard rate of capital gains tax, which is 20%. And they have to meet the following conditions. So the first condition is that the option was granted at least 2 years before the disposal of shares. Second condition is that the company is a trading company, or if it's the holding company they've granted shares over, then the holding company needs to be a holding company of a trading group, and they need to meet that requirement for the 2-year period immediately before disposal. And the employee must be working for the company when the shares are sold. Now, I mentioned that it's easier to qualify for entrepreneurs relief if your shares have been acquired through an EMI share scheme. The reason being is because where shares are not acquired under an EMI share scheme, the shareholder has to have at least a 5% stake in the business to qualify for entrepreneurs relief. But with EMI, that requirement does not apply. So you could give employees share options over a 1% holding, and they are still within a chance of getting entrepreneurs relief as long as the conditions on this particular slide are met. So that's another reason why EMI share schemes are popular. They actually give more ability to qualify for entrepreneurs relief. So I'll hand over to my colleague Amelia, who will go through a couple of worked examples so you can see how the numbers work.
Thanks, Nimesh. So we'll look through 2 examples. The first example is where the option price is the same as the market value of the shares. And the second example will be where shares are granted at a discount. So the first example, our Newco Limited grants an option to Mr. Smith, an employee of the company, on 18th of August 2020, and gives a right to Mr. Smith to purchase shares in the company for £10 a share at any time in the next 10 years. If the options are not exercised within the 10-year period, then the options will be treated as a non-tax advantage scheme. The market value of the shares at the date of the grant is also £10. Mr. Smith decides to exercise his options 3 years later, when the market value of the shares is £13. So what are the implications, tax implications for Mr. Smith? Because EMI is a tax advantage scheme, there is no income tax charge when the shares are granted to Mr. Smith. Because also the market value of the shares was the same as the option price, Mr. Smith will not pay income tax when the options are exercised. The only tax Mr. Smith will pay is on the profit he makes when he sells the shares. Then we'll look at the second example, where Newco Limited grants an option to another employee, Mrs. Smith, but this time Newco Limited grants an option to Mrs. Smith on 25th of August 2020, and the option gives a right to Mrs. Smith to purchase 5,000 shares at £10 each. The option price is less than the market value of the shares. The market value is £12, so the options are granted at a discount. Mrs. Smith decides to exercise her options 3 years later, when the market value of the shares is £15. So what are the tax implications for Mrs. Smith in this case? Because, again, it's a tax advantage scheme, there is no income tax charge at the grant of the shares. However, when Mrs. Smith exercises her options, an income tax charge will arise because the options were granted at a discount. If the shares are also readily convertible assets, i.e. quoted share, or there is an arrangement for these shares to be sold or the company to be listed, income tax and national insurance will apply at that point as well. Mrs. Smith will also pay capital gains tax when the shares are eventually sold. So we'll just look at the exercise of the options. So the income tax will be calculated by looking at the market value of the grant and the market value of exercise, and then the taxable income will be based on the lower of the two. In very rare cases, the market value at exercise will be lower. In majority of instances, market value at grant will be lower. So we calculate the value of the shares using £12 per share for the 5,000 shares, and we take away the option price or the cost for the shares, which is £50,000, leaving a taxable income of £10,000. And so Mrs. Smith will pay income tax on £10,000 through her payroll. We'll then look at the capital gains tax that Mrs. Smith will pay when she sells her shares. The shares were held for more than 2 years, and therefore the sale of the shares will also qualify for entrepreneur relief. Capital gains tax will be payable on the difference between the sales proceeds and the cost of the shares. The cost of the shares will include the option price paid on exercise and also the taxable employment income, to leave a capital gains tax to capital gains of £25,000, which will be reduced by the capital gains annual exemption of £12,300 for 2020-21 tax year. Then the chargeable gain will be taxable at 10% rate because the sale of the shares qualifies for entrepreneur relief. We'll then move on to the overview of the process of granting shares and notifying the grant to HM Revenue and Customs. The process will begin with the company identifying the key selected employee that they want to give shares to, also to decide the size of the option pool and create the cap table. The option pool is typically between 10 and 20% of the share capital of the company. And the company do not have to grant all the options now. They can also reserve a balance for future employees or just leave some of the pool unallocated. The option pool is an arrangement on paper, and no options are granted until the options are given to the employee under a share option agreement. Now, the company will also need to create a cap table, and a cap table is basically maintained in Excel format and will show the existing shareholders and the number of shares they hold. It will also show the option holders and if there is any unallocated pool. The cap table will list the nominal value of the shares, the percentage of options given to each option holder, and the total value of their holding. The company will then prepare a company valuation report, which will be sent to HM Revenue and Customs to agree the value of the shares at grant. The valuation is usually valid for 20 days, but this has been extended recently to 120 due to the current COVID situation. Once the valuation's been agreed with HM Revenue and Customs, then the company will prepare the share option agreements and working time declaration for each option holder. The share option agreements are the mechanism of granting the shares to the employees, and the working time declaration is to demonstrate that these employees are eligible employees and they work for the company for more than 25 hours per week, or if less than that, then at least 75% of their working time. Both documents are signed by the company and the employee, and the date of grant will be the date specified on the share option agreement. The company will then need to register the EMI scheme with HM Revenue and Customs through their company government gateway account. If the company does not have one, they will need to create one via HM Revenue and Customs government website. Once the account is created, they need to activate the employment-related securities service, and then from within there, to register an EMI scheme with HM Revenue and Customs. Once the scheme is registered, HM Revenue and Customs will allocate an EMI reference. And with that reference, the company or the tax agent will notify HM Revenue and Customs of the granting of the shares within 92 days of the options being granted. The final step in the process is for the company to prepare and submit an annual EMI return by 6th of July following the end of the tax year. The EMI return covers the period from 6th of April to 5th of April the following year. And if the company do not submit an annual return by the due date, then HM Revenue and Customs can charge a penalty. The penalty is £100. So what does the EMI annual return shows? Well, it shows any events, reportable events, such as exercise of the shares, or if any of the employees have left the company, then the EMI return will show that event as well. And then we can now move to the questions, and to Nimesh and Joe.
Hello, thank you very much. Okay. So for more information about getting this kind of scheme set up, I'm assuming that our audience can just contact you directly and you'll give them every assistance that they need to do that.
Yes, absolutely. We're happy to have a phone call with the clients or prospective clients as well.
Okay.
Yeah, so very much happy to arrange that phone call, or if they prefer to have a meeting, that's not a problem as well.
Okay. And we just had one question put in. If a company set up sort of in a group format, does that pose any problems for setting up this scheme?
So with the group format, you may have recalled from earlier on, with the EMI scheme, the shares have to be granted over the holding company shares rather than any subsidiaries shares. So if you've got a group situation, then you would need to think, do you want your employees to have share options over the holding company, which might have more value than what you're prepared to give away? What you could do is, in the holding company, you could introduce a new class of share, which has rights to specific parts of the group's profits. So if the employee works for one subsidiary of the group, then you could give them share options over the holding company. The holding company issues a new class of share, which only has rights over the performance of the subsidiary they work for. So there are things that can be done in a group situation, and we do have clients that have an EMI scheme in a group situation.
Okay, and one final one here. Are there any industry sectors that are not eligible for this scheme?
So yeah, there are some that I mentioned earlier. So we've got the financial services, legal firms, property development companies. We're also looking at companies that are leasing assets as well. So for example, you might have a company that rents out properties or equipment or something like that. So these kind of activities are not qualifying for EMI. But I think the best thing to do is to actually just get in touch with us, and we can actually review the company accounts and then determine whether there is any concern over whether the company qualifies before we actually do any meaningful work on it.
Okay, all right. I've got a question here from Simon. For the NI liability, does that apply to companies up for sale at the time of exercising the options, or only at the time the options are granted?
It's only when the options are exercised there's going to be a national insurance liability. So when the options are granted, there's no income tax payable and there's no national insurance. So it's only when you've got a scenario where at the time of exercise, let's just say, for example, you're granting share options over X number of shares, and they can't be exercised until, let's just say, until the company is sold in its entirety, and along comes a prospective buyer for the company. They've agreed terms. So what would happen is that the employee will exercise their right to acquire the shares, and because the company has arrangements to be sold, there'll be a national insurance liability at the time of exercise.
Okay. I got another question here from Tim, actually. How is a company valued? So is this a multiple of profits? And if so, what is the normally accepted multiple?
So for most of our clients, if it's a company that has a history of making profits, then what we will do is review the accounts and look at the profits the company's made over the last 3 years. And as part of that valuation report, we will analyse those last 3 accounting periods and come up with what we call a weighted profit. So the more recent accounting period profits carry more weight in the valuation compared with the profits of, say, 3 years ago. So what we will do then is we will look at the profits, analyse them, look at the industry they operate in, and then use a multiplier to work out, the basis of the valuation. We also, in some instances, look at the balance sheet and the net assets on there, and the working capital requirements can discount the value. With EMI share schemes, quite often giving away a small stake, so we can work out what discounts would be appropriate to reflect the fact there's a minority shareholding, or the shares might have less rights compared to the existing shares, and so on. So there are various methods that can be used, but it depends on the circumstances of the company. There might be companies that are in their initial stages and we have to come up with a different method to value them. Or this year in particular, actually, we might need to look at the forecast for the current period and try and work out how to reduce the value in that way as well. So there isn't a one-size-fits-all method, but we will obviously review each company in isolation and work out what's the best way to agree the value with HMRC.
Okay. All right. Well, thank you very much, Amelia and Nimesh. Very interesting. For all of our participants this morning, we will make an on-demand version, an on-demand version of this webinar available on our website later on today. I hope that you all enjoyed it, and we look forward to our next one. Thank you.